For us to understand the lesson better, let's have a look at the basics of market structure first. We all know in an uptrend, the market is characterized by a series of higher highs and higher lows. A new higher low is created when it breaks the current higher high. This continues until the low creates a new strong high that pushes the price below it, popularly known as what we call the change of character. Basically, what do we mean? So the market has to create a series of higher highs. What we have here is the high. What we have here is a low. As long as it breaks this point. Now, if it breaks that point, we have this is now a low, and this is now the new high. So this is a high, this one is above that. Basically, under the basic market structure, we know that if the market is moving in this kind of a market scenario, we say that it is in an uptrend. So if it pulls back into the range and then proceeds to break the high, now this is the current low, this is the current high. Now, the process continues until when the current higher low is taken out. So if this point is taken out, now we can say that we have a change of character at this very point. So this is what we call now the basics of market structure. What about in a downtrend? As we all know that the market is characterized by a series of lower lows and lower highs, where a new lower high is created when it pushes the price below the lower low that created it. This continues until the current lower high is taken out, what we call the change of character or trend reversal. It is just in the same thing that the market has to proceed by making new lower lows. So we have a low here. This one is below that, so it is a lower low. Below that, we have another one, which is a lower low. So as long as the market continues making this kind of a series, then we say that it is in a downtrend. Until now, here we have a high. Let's assume that this is a high. So the market creates a new high, which is now what we call a higher high. This continues until the last higher high, lower high, sorry for that. The last lower high is taken out by the price at this very exact moment. Now, this is what we call a change of character when you talk of the basic market market structure. Now, from that, as per my study, I have noted that we have advanced part of market structure, and that is what I want us to learn today. We have 4 types of advanced market structures, that is support and resistance, demand and supply, base rally base, rally base rally, drop base drop. So depending on that, the 4 types of market structure, we will also go through and also study on how to use this kind of a concept in market entries, or on how to find the best entries in the market. All these 4 types of market structures are continuous in nature. That means they show that the market is going to continue in that very specified direction. Before we proceed with the lesson, if you are new, consider subscribing, like, and leave a comment concerning your idea. Now, let's continue with our lesson. So for you to know how to use this concept in market entries, stick to the end of the video. That will give you the best experience that you need as part of my audience. Now, after learning the basics of the types of advanced market structures, the next question that you're supposed to ask yourself is this simple question: that how do we use this knowledge to identify entries? For you to get that concept, ensure you stick to the end of the video. A range is formed by the high prior to the break and low that pushed price to break the high, what I call the operating range. This is where the holders to rest for pushing the price higher or lower depending on the initial direction. So that is exactly what I call an operating range. Like in this case, we can see that the market is moving in an upward kind of a direction. So now, for us to identify the range, because we need to understand the concept about ranges, if you'll have to continue using the concept. So now, the high and the low that pushed price to break this high is what we call the operating range. So anything that is happening in between here, that is now what we call an operating range. If the price continues, moves out of the range, and then creates another high to pull back into the range, and then proceeds again to break that point. Now we have the new range, which is made up of this low and this high. So we have orders here that will push the price. So that is why if the market pulls back into the range, it cannot break past this point, because now that will lead to what we are calling the change of character. So in most cases, we know that if the market has to pull down back into the range, that it will find an inefficiency. It could be a fair value gap, could be an hidden block, could be a volume gap, or anything, any kind of inefficiency that is created in by the market. So that if the market pulls back into that exact point, it might buy further from that point. The exact way. Now we have a new high, and we have a low that have broken that point, which is at exactly at this point. So whatever is happening in between here is what we call now an operating range, and this kind of a movement is what we call internal the internal liquidity, that in between or a range within a range. So we know that the market has to continue moving, pushing high from this point. So we know that the market now has started forming another kind of a structure in between the initial structure. But we cannot say that this is a low that created this high. But basically, this is a low that created this high. Depending on how I define a low, I know that a low is any point that creates a new high. So if a point has not created a new high, I cannot define that as a low. So we need to understand that concept better. Now that we have the concept about an operating range, let's get into the first type of an advanced kind of a market structure, which is support and resistance. With support and resistance, this happens when the market breaks out of the trading range and revisits the broken high without proceeding deeper into the range, that is in an uptrend, or revisiting the broken low in a downtrend, in what we call the flip zones. In this kind of a market structure, support resistance turns to support, and support turns to resistance. That is basically, this is exactly what we mean. Let's have a look at a chart. So we see that the market, after escaping from the range, because this is a initial range, after the market escapes out of the range, it just revisits the high, because this is a high that has been taken out. The market revisits that high. It doesn't get deep into the range, just to proceed to create a new range. And then after breaking this high, it just revisits the top, and the same continues until when the market now takes out the created low that is made up of the flip zone. So if that continues until now, the market has changed the character. But this is exactly what I want us to learn from this point. That the first example that we have checked out, it was about now in an uptrend. Now, in a case where the market is moving in a downward kind of movement, that we know that if the market escapes out of the trading range, because this is the operating range, and then instead of revisiting deep into the range, it just revisits the broken point. That is now what we call now the support turning into resistance. The other case, we have the market now, this is the operating range, but the market after breaking the range, it doesn't get back into the range, just revisits this exact high or the exact broken point. We have the market pushing lower to break the high, creating another range between this point and this point. That is now our new range. We have the market now, after breaching another down, we have a new range. But now instead of the market bouncing back from the broken range, we have the market going deep into the range, even to an extent of taking the previous lower high. So in that case, that is what, in this kind of a scenario, we say that the market has changed character, or there is a reversal in that very trend. So that is the case where we have the support and resistance kind of a market structure. Now we are going to the other type of a market structure that we call demand and supply, and that is forms part of my favorite trading strategy. So we better pay attention to that, because that is what I'll be teaching most of the times. Now that we've understood that better, let's get into the other interesting type of market structure, that is the supply and demand. This forms part of my favorite trading. This forms part of my favorite trading strategy. It happens when the market escapes out of the operating range and revisits the extremes before proceeding in the specified direction or in the direction of the break of the range. The best way to identify the price extremes, the best way to identify the price extremes, the best way to identify the extremes to purchase from is by plotting the Fibs tool from the high to the low. In red is the premium selling zone, and in black is the discount buying zone. The process continues until there is a change of character, or definitely what we call a change of. Now, this is what we call an operating range, as we all know. So this is the high of the operating range, or the low, the high. If it is taken out, we will have a break of structure. And this is the low that if it is taken out, we will have a change of character. Those are the 2 points that we are supposed to pay attention to. Now you plot your Fibonacci. This is just the Fibonacci 2, marked in red and black zones. So in black zone, this is the operating area where you can only purchase the market. And this is the operating area where you can distribute the market. But we need to understand that you can only be buying discounts. That you can only be buying discounts in an uptrend and selling premiums in a downtrend. We need to understand that better. Don't do a mistake of selling the premium in an uptrend or buying the discounts in a downtrend. That will be a very costly mistake. Now, assuming that we just need to identify the next one so that we get to know if you were in this kind of a market scenario, where would you have bought the market? We just move our Fibonacci from this, because now this is the new operating range. So we cover the high, that is a high, and this is a low. So now this is the new operating range. So we know that if the market pulls back from to this point, that we could only get to purchase from that exact point. So if the market pulled back to this exact point, we are to purchase. So we know this high. If someone is going to take a position based on this movement, that they are supposed to target the other extreme point, which is now the premium zone, which is the most expensive zone. You can also target anywhere within this, because we know that if the market has to continue this specified direction, it has to take out this high before pulling back to another point and then proceeding to the exact area. So this is the second type of a market structure, and it is one of the best market structures that we can have around. And basically, it forms part of my trading strategy. My trading strategy is just based on the discount and premium levels, as we all know that only institutional traders that have the power to purchase from the discount and premium levels. So because we don't have the power to do so, we want to ensure that we are flowing, or we are just following the money where it is. It is good as a beginner trader and as an intermediate trader, as an advanced trader, to get a good concept about how these premium and discount levels work. I think we will have a video in future about this. So we just pay attention and do the right thing for now. So now that we have an idea about that, we want to go to the last type of a market structure, that is drop-based drop, rally-based rally. And then from that, we are going to check how can we enter the market based on these exact market structures. So kindly, if you have not subscribed, ensure that you have subscribed to our course, and ensure that you follow the content to the end of it. We will always be releasing videos after the other. Don't forget to comment. Before we get into the other type of market structure, that is base rally, rally-based rally, drop-based drop, then we need to check a chart example of the supply and demand. So in this case, we have the market as this at the originating point. So the market buys to a specific point and pulls back deep into the range and then proceeds to take out this point. Now, after taking this point, we want the market to revisit the extreme, which is this exact point. So the market revisits this extreme without taking out this point, without taking out the low, then that is now where the market is buying from a discount level or from a demand level. Now, the market escapes again from the range. So what we want is that the market cannot break past this point. So if it does so, then we have a change of character. But if it remains without violating the zone, then we are assured that the market must continue that very specified direction. So we have this now in the trading range. Now the market buys from this exact point. We know that if the market takes this point out, that there will be a chance of the market pulling down to this exact point. So we'll be waiting for the market to take out the high, react from here, and then pull back all the way to this exact trading point. So that is now a live chart example when it comes to supply and demand. Now let's get to the other type of a market structure. The other type of advanced market structure is what we call rally-based rally, drop-based drop. It happens in most cases, and it is when the market, after escaping the operating range, it doesn't revisit the high or the extremes of the range again. It consolidates or accumulates above it and proceeds in the direction of the break. This happens in most cases when one force, either buyers or sellers, are strongly controlling the market. In what we call, in classic chart pattern, this is what they call the flag pattern. Like in this case, what we have right here, we have the market being in an uptrend. And then we have the market forming some bases. So because this is just a pump, what we call a rally, because when the market is buying upwards, that is what we call a rally. The market rests around here, pumps again, consolidates, pumps again, consolidates, pumps, consolidates, and the process continues. But the market, what we want to see is that the market doesn't revisit this extreme. So we see that after the market escaped out of the range, it did not revisit here. The other case applies to this. After the market escaped all the way to this point, it did not pull back to this exact point, but consolidated above it to give what we call now a base or an accumulation, or what we call orders accumulation. So that is a case of a rally-based rally. But before we get into that, maybe some of the traders understand better in a line chart. We can do that. Let's just have a line chart in this case. So this is it now. I think this is better for some of us. That after the market escapes out of the range, assuming that is the first range, now it forms another range without revisiting this one, because the market did not cover that distance in what we call undistributed price, imbalanced price distribution. So price escapes out of the exact range, consolidates above it without revisiting this one. So there is a lot of imbalance in prices because one force is controlling the market strongly. We have the market escaping out of the range, and then again to that exact point. So that is a case where we say that the market is unevenly distributed, or the price is unevenly distributed. Let's just have a look at the case where we have rally-based rally, drop-based drop, and this is a kind of a scenario is still where the sellers are controlling the market with a very strong force, that the buyers do not get a share to control the market or to mitigate the zones. Like in this case, we have the market dropping, that is what we call a drop, accumulating at this exact point, forming what we call a base, escaping out of the range or escaping out of the base, accumulates again, escapes out of the range, accumulates without revisiting the prior accumulating points. That is very important that we need to understand so that at least we can be able to. But just as a bonus, as a trader, you cannot be trading all these kinds of market structures. So you need to identify one that will work best for you. You either decide to trade support and resistance, demand and supply, rally-based rally, drop-based drop. So that is all about the basics of the advanced part of market structure. Remember, we have gone through the 4: support and resistance, rally-based rally, drop-based